And ladies and gentlemen, we are live 7 p.m. Pacific Standard Time on the West Coast. Thank you to the millions, my he-hims, my she-hers, my they-thems, my zeezers, and anything in between. Thank you very, very much for tuning in for prime time coverage on the Dylan Holley Experience, your midweek market recap. It's been quite a fun 3 days thus far. There's been a myriad of announcements, a myriad of stock movements and market movements in general. So let's just jump straight into it. NASDAQ 100 futures fall after major averages and a 2-day rally. Let's continue on. NASDAQ 100 futures fell on Wednesday night after surging treasury yields ended a 2-day rally for the major averages. Futures linked to the Dow Jones Industrial Average dipped by 12 points or 0.04%. S&P 500 futures declined 0.26%, while NASDAQ 100 futures fell 0.49%. Tesla shares dropped 4.5% in extended trading after the electric vehicle maker reported third quarter revenues that missed analysts' expectations, though it beat on earnings. And more on this later. We're going to be talking a little bit more about Tesla's earnings call, along with another major tech company. In fact, it's a FANG company. Just to spoil it a little bit. During the regular session Wednesday, the major averages snapped a 2-day winning streak, though all three indexes remain on track for a positive week. The Dow Jones declined 99.99 points, so about $99.99, or 0.33%. The NASDAQ composite fell 0.85%, while the S&P 500 slid 0.67%. Investors monitored rising treasury yields for recession signals, even with a stronger than expected earnings season underway. On Wednesday, the yield on the benchmark 10-year treasury note traded as high as 4.136%, or its highest level since July of 2008. So maybe it's becoming opportune again to possibly invest into bonds. This is the first time bonds have really been competitive, in my opinion, in the last 15 years, which clearly, it's the highest level since 2008. Again, it's not financial advice. I am only telling you what I'm doing. And right now, just to disclose it, I have 10% of my 401k right now sitting in US Treasury bonds. At some point, I may switch it. I may not. It's totally up to my disposition, but just for the sake of transparency, I am holding United States Treasury bonds right now. It's generally like a mutual bucket index. I don't know exactly what it is. It's through Fidelity, just for transparency's sake. But yeah, it looks like stuff is starting to rebound on the Dow Jones Industrial Average and the S&P 500 actually. Now, from a macro perspective on the weekly charts, it does look good. I mean, the Dow Jones specifically fell below the 220-day exponential moving average, and it quickly fell below, and it looks like it retested. And if you look at momentum indicators and in relative strength indexes, it's been its lowest. This was the level right here. This exact volume or this price level on the relative strength index, I highlighted it. It was basically when in 1933 the lowest it went. So it looks like it got pretty low. The actual volume, the buying volume there got pretty low, and it actually in May and June tested that level, and it tended to bounce back up. Again, I don't claim to be a trader. I don't have any active options plays or anything like that. But from a charting perspective, and then we start to expand on the 2-week now. We were on the weekly, but now on the 2-week, it does look like a pretty strong market reversal. Maybe. But you're also pairing that in tandem with, I feel like it seems like inflation is still on the rise. Technically, the CPI came out last week, and it was hotter than anticipated by 0.1%. So year over year prices are still rising, at least with the consumer pricing index. If you look at the S&P 500, it tends to follow the same market movements as the Dow Jones. They tend to mirror each other pretty closely. Most of them kind of have parity within the actual holdings and everything. So again, I'm still dollar cost averaging into the Dow Jones and the S&P 500, specifically the S&P 500, but I feel like the Dow Jones is more emblematic of just investing into the market. But again, it really doesn't matter to me what the short term, and I consider short term like 5 to 10 years, what the 5 to 10 year price movement on these assets are going to be, because frankly, I'm a net accumulator of the S&P 500, of Bitcoin, of Ethereum, of Solana, and at these prices, would I prefer them to be at all-time highs? Would I prefer nothing but all-time highs each and every single day? Of course. But that's just not the nature of the beast. That's not how nature works. So again, I'm going to keep buying. This is, in my opinion, in my humble opinion, this is a very prime time to be purchasing Bitcoin. I mean, this level right here, like this trading under this level on the weekly chart. If we run it back all the way down to 2018, 2017, I mean, look at this. Like, this was the prime area to be buying Bitcoin, right? Primary to be buying Bitcoin, no question. I mean, this is where you could snag it at $3,200, and then you have a price run up to 69,000. Very nice. And it's now trading in terms of the relative context of Bitcoin in 2018. It's now significantly trading below that 220 exponential moving average. So again, this is a prime time, in my opinion, to be buying these assets. I'm someone who will never have enough of blue chip assets. So frankly, any market climate is evergreen to be purchasing these assets. They are evergreen assets, in my opinion. So it really doesn't matter to me if Bitcoin's down 80%, up 80% from where I've been buying it. Same thing with the S&P 500, Ethereum, and Solana. And I guess technically now government bonds too. I've just been dollar cost averaging into those. I don't really look too heavily at them. That's more of my market volatility hedge. That being said, I am still down in my 401k like 21%. So take it that what you will. But right now I am sitting in those assets. Let's run it back to what's going on with these indexes. Quote, we're in this position where the Fed is in control. Bryn Talkington, managing partner at Requisite Capital Management, said on Wednesday on CNBC's Closing Bell Overtime. The 2-year leads the Fed, and as long as the 2-year continues to go higher, we will not make a bottom in stocks, and the equity rally will not continue. So what she's saying here, what Bryn is saying here is, if interest rates on bonds, on treasury bonds, continue to increase, we are not going to see a bottom yet. So the stock market, the Dow Jones, the S&P, hell, you can throw Bitcoin, Ethereum, and Solana in there. We are not at the bottom as long as the Fed keeps bumping rates, which they've already told us they are bumping rates 2 times this year, like 2 times by the time we end this year. 75 basis points in November, 50 basis points in December. And that's what's priced in. That's what they've told us is going to happen. If it's even hotter than expected, if it's even more aggressive inflation, then they may have another 75 basis point move in December. Nonetheless, based off of what the Fed has told us and this person's hypothesis right here, she's saying that we're going to keep going lower. And if that's the case, I'm going to keep buying. Just like if we go higher, I'm going to keep buying. Alaska Air Group, Freeport McMoran, Tractor Supply, American Airlines, Union Pacific, CSX, AT&T are set to report earnings Thursday. You bet your sweet bucket we're going to be covering those on the end of the week market recap. On the economic front, the Philadelphia Fed manufacturing survey and the weekly jobless claims data are expected Thursday before the bell. So we are getting some jam-packed news. I'm very excited for the next 2 weeks. For the midweek market recap and the end of the week market recap, because we're getting earnings reports, we're getting Fed reports, we're getting job reports, we're getting manufacturing reports. It's just this is a very grand time of each quarter. It's very nice. Now, speaking of earnings reports, first things first, let's break down Tesla's earnings report right here. So they were anticipated to earn 99 cents per share, which was adjusted. So I believe they actually lowered their earnings estimate, or analysts at least, but their earnings blew past Tesla. That is, blew past by 6 cents to $1.05, which is good, especially in this economy. A positive earnings report, yeah, it's good. That being said, they did miss their revenue, which, $21.45 billion earned versus the $21.96 billion expected. The fact that they're still showing earnings per share, I think is good. I feel like this is the more important number. The actual money that they're pulling in, Tesla is making major investments. And I think this is what Musk is doing. Musk is making major investments into the actual infrastructure right now of Tesla. So the short-term profitability of that won't really be seen because that's not really how infrastructure and building out infrastructure works. Like at first, it is a money suck, and it really is a money pit because you're making a major investment into making new charging stations, into making new manufacturing plants, solar plants, stuff like that. And you're not really seeing that profit come back. But the whole name of the game, what Tesla's trying to do is build out a robust infrastructure for their products. And then once they get the economy of scale going, they build, they were saying the $20,000 Tesla, that Corolla killer, once they hit the economy of scale, I think now with inflation is probably going to be the $25,000 to $30,000 sedan, which again, still not a bad thing. If Tesla can pull out a Camry killer, that's big right there. Like that's a major step in normalizing EVs for the market and making it so it's not just a fringe. I think like 3% of cars on the road right now are EVs. I think that if they were to hit an economy of scale, and especially now with other car manufacturers too, there's way more competition in the EV sector. Once all of those other major manufacturers really start to compete against each other with like a super robust EV product from all of these different manufacturers, I think stuff's going to get really real. Like Tesla right now is still far and away the king of the EV market. I mean, their cars just have better range. They have a better charging network, a faster charging network, a better software experience. They've really brought it down because Tesla, they've had basically 20 years of basically controlling the high end technology driven battery powered car market. And you have Ford and GM and I guess Toyota's been doing it too, but they haven't really made that full step like Tesla has. Now Honda and Hyundai, they've really only had at most 4 to 5 years to really try to challenge Tesla. So once this starts to mature a lot more, I think we're going to see a lot better products. Like Tesla's right now, typically they're getting anywhere between 250 to 320 miles of range, depending on your model, versus, just some random EV car. They tend to be on the lower end of that Tesla estimate. So I think the cars are going to get better. The traditional car manufacturers are going to find their footing in creating a more competitive EV. But for right now, I think Tesla is still taking the advantage. I feel like Tesla is still far and away the best EV car company. Musk talks. He also talked about the Twitter takeover. It's not really a takeover. It's more just him purchasing it. But yeah, he was talking further about the fact he's wanting to build the all-in-one app X to challenge China's WeChat app. So that's pretty dystopian. They're just making the American version of WeChat, which, I think having an all-in-one app is fine, but giving we don't really solve an issue by giving power from one technocratic party to another technocratic party. Like it's just they're one and the same. Like Musk, who is a multi-billionaire, is purchasing the company from Parag Agrawal, who I don't think is a multi-billionaire, but he's purchasing $1 billion company and will now basically control the single biggest public forum in America. I mean, or meaningful public forum. Like I know Facebook is still there and more people use Facebook, but I don't know, man. I'm on Facebook. I feel like there's not any super crazy political commentary going on. It's mostly just boomers, kind of in their echo chambers. And I guess Twitter is no different. It's basically just Gen Z and millennials in their echo chambers. But I don't know. I feel like more poignant political commentary happens on Twitter, and a billionaire is controlling it. Do I prefer this billionaire controlling it over the parties that already were? I guess, but it's still a billionaire nonetheless. So having Musk own Twitter is not just this, oh my gosh, everything's going to be saved, everything's going to be fixed. There's still going to be problems, and I think there's still going to be the glaring problems that we have now with Twitter. I think it'll basically just be the same thing. But Donald Trump might get unbanned, and that will be very, very entertaining if he runs in 2024. So when Musk does end up getting control of Twitter, just unban Donald Trump. I just want to see it, man. Every day it was just something outrageous. I'd wake up and it was something outrageous, and I just miss it. I miss the chaos. I'm not gonna lie. And to continue on the earnings train, Netflix, who was down bad. I think they're down like 20, or no, it's way more than 20. I think they might be down like 50% this year. I have not taken a look at the Netflix price movement over the last few months, but I know they're down horrendous. Oh yeah, no, they're down like 60%, 70%. Okay, yeah, so they're down 70%. They are definitely 100% down bad. Netflix had a pretty killer earnings report that came out Tuesday. Excuse me. They added 2.41 million subscribers during the quarter, higher than the 1 million subscribers that it had forecasted. I think this is generally in part to Dahmer. I'm pretty sure Dahmer's like the second most watched Netflix series in history. So also they've just been dropping bangers like Stranger Things season 4. I still haven't finished it. I have 2 episodes left, but it is by far the best Stranger Things season I have. Like I watched. Season 1 was okay. Season 2 was pretty mid. 3, I really like Stranger Things season 3, but season 4 is just it's a certified hood classic. It is a masterpiece. I love Stranger Things season 4, and I haven't even finished it yet. But yeah, so Netflix has been hitting it out of the park with their Netflix original content, and it shows because the earnings report, the earnings per share, from a $2.13 earnings per share that was estimated, they earned $3.10. So they earned $1 more than what was expected per share, which is a significant amount of money. The revenue from the $7.837 billion that was expected, they earned $7.93 billion. So they earned an extra $10 billion. They outperformed by $10 billion worth of revenue. And of course, they basically added over 1 million extra subscribers than what they were anticipated to do. So they really knocked it out of the park. Again, I feel like it's kind of skewed because they brought down all of their earnings estimates and all of their subscriber growth estimates and revenue estimates after the first 2 quarters because they were really not great for Netflix. They ended up reporting their first negative subscriber growth in the history of the company. So I think everyone got pretty gung-ho on just like shorting the stock, which I mean, those who shorted the stock are definitely profitable right now. I mean, that is a fat drop. That is a very fat drop for like basically what was considered a vanguard of the market. It was on the S&P 500. It was on the NASDAQ, or it's still on the S&P and the NASDAQ 100. It's a FANG stock. And to be fair, the FANG stocks have been kind of getting dunked on. I mean, Meta, which was also like seen as a vanguard of the market, it's also down like 70% or 60%. Mark Zuckerberg personally is down $90 billion this year, which just brings a smile to my face. I don't know. There's just something so beautiful about being down $90 billion in less than a year. But yeah, Netflix, very, very great earnings report. I don't know if they're going to keep this going. I don't like the only Netflix exposure I have is in my S&P 500 index. And that's it. I have no other Netflix exposure. I don't really like Netflix. I still think it's overvalued. I don't know if it's also this is what a mature streaming service looks like. With streaming services, the whole value proposition of an investor side is there's going to be more people that are going to be paying for that service. So it's going to continue to grow at a pretty exponential rate. But Netflix is so mature and so ubiquitous now in households, 100 million Americans. I think how many Netflix subscriptions are there? I'm pretty sure there's like 100 million. Let me see. Netflix subscription numbers. 220.67 million Netflix subscribers that are paying for it. Dude, that's very saturated. This is a very saturated market. So now the value proposition with Netflix is no longer subscriber growth, but they've basically locked themselves in because I mean, I guess with this quarter, they've actually added more subscribers, but from a macro long-term perspective, they really can't grow significantly any further in terms of maximizing their subscriber base, the amount of people that are actually giving them the revenue, because it's so saturated and so mature as a streaming service now. They've basically locked themselves into a set amount of revenue each month, each day. But they have to keep paying more on interesting content to keep those people subscribed. So they're going to start racking up, I think, more debt and more expenses, more corporate debt to be able to pay for more interesting content and meaningful content. But they're going to kind of be locked into the same revenue structure month to month because it's so mature. Anyway, that's my spinfoil hat theory on what's going to happen to Netflix. Again, I guess I have indirect exposure to it in my S&P 500 index, so take it that what you will. Now, looking at Tesla's, this was a little more, ipso facto. Who knows? It's a little más o menos. Their earnings were solid. They actually beat earnings, but their revenue was down. Also, though, they are. I think they lowered their delivery reports too. Let's take a look in here. Reported offered no firm time. Oh, that hurts. Tesla offered no firm timeline for the production of the Cybertruck pickup. Man, I want the Cybertruck so bad. It's so beautiful. It's so beautiful. But enough of Tesla. It's enough of Netflix. It's Apple time, baby. Apple just announced some brand new consumer goods for us, the masses, the Apple sheep. So let's talk about what's new with the Apple lineup. They just recently updated their Apple 4K. It's starting at $129. It has the A15 Bionic chip, which is the chip in the iPhone 13 and 13 Pro series, and the regular iPhone 14 series. They also introduced HDR10 Plus on the Apple TV. If I'm going to be honest, the Apple TV is one of the more boring products in Apple's lineup, if not maybe the most boring. I do like some of the features they have. They have color calibration and color balance, so it's just like natively built in, plus you can use your iPhone for it. I do think it works well within Apple's product lineup. I just don't find it that interesting. I have a smart TV, and I feel like it's pretty expensive. Like, you can get like an Amazon Fire Stick for like $50. I think if Apple made like an Apple TV stick that did 4K, that would be very, very interesting. But yeah, it has a better chip and HDR10 Plus now, and that's about it. There's nothing special about the Apple TV 4K. I think there's better products in this product category for a significantly cheaper price. That cannot be said about the tablet lineup from Apple. I feel like these are some of the best. These are by far the best tablets in the tablet business, in the tablet technological sector, and they just made it even better. They just made the iPad probably the best iPad they've ever made. I mean, it first things first, it has a brand new design. So it takes that iPad Pro and iPad Air, and I guess iPad mini now, design language and design philosophy. It's 10.9 inches across, and it comes with these pretty awesome colors, man. I love that blue. I love that purple. Ooh, it looks beautiful, man. Let's continue on. It's 10.9 inches. As we've said, there's a brand new folio case. You see that? You'll see that? There we go. Look at that folio case. Look at that folio case. Again, it uses magnetic. It uses magnets, and it uses the Apple Smart Connector right there. That's built into the iPad. And it uses, if we take a look down here, the A14 Bionic chip, which is the chip in the iPhone 12 and 12 Pro series. Everyone's been giving Apple heat for introducing new products with their old CPUs and everything, and I totally get it. I think that's totally valid. You're a $2 trillion company, formerly $3 trillion company, basically the vanguard of the industry, and not just of like the technological industry, but of the entire market. Like, Apple is the biggest company, publicly traded company in the entire world. So why are they just introducing new products with the chips that we've seen from last year's model or a model from 2 years ago? Like, that's what they're doing with this one. But I do think there was something to be said about what was going on with the chip crisis, the silicon manufacturing crisis, and the supply chain crisis, which we will talk about in a little bit on a deeper level. But they already know that their processors are the best in the business. They're the Apple A series, which is for their mobile processors, and their M series, which is in their Macs and iPad Pros, which we will also be talking about right after this. They're the best in the business. And frankly, you're not really going to be editing or doing anything super crazy on just like a regular iPad. So they know that they can get away with this A14 Bionic from 2 years ago because it's going to be good, you know? What I prefer, they have the best in line chip in the iPad, I guess so. But from a manufacturing standpoint, from a usability standpoint, it's not going to make any significant difference. And what I think the general consumer Apple is targeting with this is, I really don't think they're going to notice a difference between the A14 Bionic and like the M2 or the rumored M2 Ultra. I don't think they're going to notice it. Plus, it helps them cut down on the price because they can just recycle unused 12s and 12 Pros and other iPads that used this exact chip previously. They can just recycle those and put them into this new body and sell it at a pretty cheap price. That being said, it does start at $449, so it's not super cheap. But I think if you do the education discount, it does start to get advantageous. And I know I think for like schools and stuff like that, they also do the buying in bulk. So take it that what you will. I think the iPad's solid. I think this is going to be the best mass market iPad that you can get for most people. I really don't think you can get a better tablet than this. But from a technological standpoint and from a more hardcore use standpoint, the iPad Pro, baby, just recently updated. This is probably the best tablet from a processing standpoint, from a usability standpoint, from a design standpoint, and technological standpoint on the market today. No question about it. The iPad Pro, which was previously, the previous generation was powered by Apple's M1 chip, which is used in their Macs. Now it's powered by the M2 chip, which provides some pretty significant processing performance increases. And let's start breaking it down. First things first, there are two models. There is an 11-inch model, which is going to be this one, I presume, back here, and a 12.9-inch model. The 11-inch model starts at $799, and for the 12.9-inch model, it starts at $1,099. So it's definitely a pretty penny. I'm not going to lie, but you're getting a lot with this thing. First things first, you are getting the M2 chip. Now, these numbers that Apple's touting, they are based off of performance increases from the last generation of the Apple Silicon, which is the M1. So the 8-core CPU provides 15% faster performance than the M1. The 10-core GPU provides 35% faster graphics performance than the M1. And with a updated neural engine, which is used for machine learning processes, it is a 16-core neural engine, and it's 40% faster in machine learning tasks than the M1 chip, while also providing 50% more memory bandwidth than the M1 chip. So it is significantly faster than the previous generation, and they just stuck it in the iPad. So if you're doing any super crazy editing or video editing, stuff like that, photo editing, and you want to get an iPad, get the M2 iPad Pro because it's very, very good. Now, let's take a look at some of these screens for a bit. So for the 12.9-inch, it has a mini LED display, and it's the best screen that Apple's ever put into an iPad. It better be. But it is very, very good. It has very deep blacks, at least from what I've heard. Apple didn't give me one. I'm a small time right now. I'm a little minnow. But from what I've seen and heard, this is a fantastic screen. It uses the mini LED technology that they introduced, I believe, on the M1 iPad Pro. So it provides very, very deep blacks, very saturated colors, just a beautiful screen on the 12.9-inch. And on the 11-inch, are they going to have us take a look at this? There we go. On the 11-inch, it still has the Liquid Retina display, which is an LCD display. It's still going to be good. You know, it's still going to be probably better than most Android tablets and most Android phones. I said it. Apple makes better products than most Android manufacturers. Hopefully that's not controversial. It's just true. Both of these models, so the 12.9 inch with mini LED and the 11 inch with LCD, are both going to have a true tone display. So it's going to be able to change the actual color, so it's easier on your eyes. It's going to be a little more orange. I personally use it. I love it. While also having a 120 hertz adaptive Pro motion display. So it's got those juicy animations, just some beautiful animations. And they both now have 5G. So if you're working on the go, you've got 5G. I don't think they've updated the cameras. If you're taking photos on your iPad, that's kind of weird. I'm not even going to lie. But it has an ultra wide and a normal camera. So if you want to, they're there. Use them. I have never really used a camera on my iPad. But I guess this is pretty cool. I guess you can do the AR technology stuff right now, which is pretty awesome. Also, it has 5G and Wi-Fi 6E. It's up to 2 times faster download speeds than the previous generation, so the M1 iPad Pro. Awesome. I'm happy they've made it faster. But yeah, this is just a great product, man. Like an iPad Pro, an M2 iPad Pro, I would definitely get. I really hope they introduce the mini LED onto the 11 inch. I feel like 12.9 is a little large for me. I would definitely be cool with the 11 inch. And I'm sure the LCD display is good, but I really want mini LED. I really want some saturated pixels, man. Woo! It's just beautiful. I'd be howling. Now, speaking, let's run it back a little bit to that iPad 10.9-ish with the A14 Bionic talk. And you know, I was talking about how there has been that supply chain crisis with being able to ship new products over, and there is the chip shortage as well. Manufacturing bases were shut down in China and Taiwan, or I guess Chinese Taipei. I want to be politically correct for the CCP. Excuse me, Chinese Taipei. But they've been counteracting that. They've been working around these issues with having those those previous and older generation chips be put into their brand new products. So, you know, they still operate pretty well. There's not really going to be a noticeable difference, but that may be coming to an end. After 2 years of shipping snarls, things are starting to turn around. After 2 years of port congestions and container shortages, disruptions are now easing as Chinese exports slow in light of waning demand from Western economies and softer global economic conditions. Logistics data shows. Quote, the retailers and the bigger buyers or shippers are more cautious about the outlook on demand and are ordering less. Quote, on the other hand, the congestion is easing with the vessel waiting times, reducing ports operating at a less capacity, and the container turnaround times decreasing, which ultimately frees up the capacity in the market. Let's take a gander here. Yeah, so the World Container Index, we can actually pull it up here too, so we can get a better view of it. We can run it, I believe, there we go. We'll actually get rid of some of these tabs because we're not really talking about Tesla anymore. So on the World Container Index, which is basically the cost of a shipping freight from, and it's any major trade route, but you know, it's like Shanghai to Rotterdam, Rotterdam to Shanghai, Shanghai to LA, LA to Shanghai, Shanghai to Genoa, New York to Rotterdam, and Rotterdam to New York. So basically taking the averages of how much it costs to ship freights from one place to another using the major trade routes. It peaked at about $10,377 in September of 2021, and it's now down 64%. It's now down 64% from that point to $3,483. But to be fair, if we take a look at it in context, pre-COVID, so yeah, let's take a look pre-COVID, like October of 2019. Yeah. October of 2019, the cost of a shipping container was $1,228. So even though it's down 64% from where it was, it's still up almost 300% from where it was pre-COVID. So context does matter, but it's getting cheaper to ship stuff. And I think on top of that, by having a world recession, frankly, I think we're in a recession right now. By having a recession, it's lowering consumer demand. And consumers are buying less stuff. I think that's generally fair. The supply chain crisis, as we knew it during 2020 and 2021, I think it's over. I think we're going to start having a surplus of goods again after that extreme shortage of goods and not mostly services, but primarily goods. I feel like that's done. I feel like we are going to start getting a lot more supply than demand. So I think prices, maybe not with inflation, are going to be dropping, but in theory they should be if the Fed doesn't print more money. But they're also locking up credit markets and quantitatively tightening. So maybe we will start to see some deflation action going on. That would be gnarly, man. I know during 1929 and 1933, we can actually take a look here, inflation calculator. There was some pretty significant deflation going on. So, we haven't really seen a significant deflationary period like that. We've seen stagflation, of course, in the 1970s and hardcore inflation right now. So there's that, but from a deflationary period, the cumulative rate of inflation from 1929 to 33 was negative $24. So deflation was at 24%. Could you imagine if we see, inflation at 24%? This is the inverse of that. So I think we may be possibly going into a hardcore deflationary environment, but there's also an argument that says we can be going into a hardcore inflationary environment. Again, I'm not here to give you what's going to happen to the market. I'm just telling you what's happening in the market right now and giving you some historical context, because that's very, very helpful. That's what I like to give. I don't take my word as the gospel. You should definitely not take my word as the gospel. I'm just giving my opinion. But yeah, we haven't seen a hardcore deflationary period in basically 100 years. So I think at some point in world history, we will see deflation once more in a very significant exposure instead of inflation in that type of environment and climate. But before that, before we get rocked by crazy and high inflation or deflation, apparently the U.S. economy is healthy. Bank of America CEO says latest spending and savings data show that the U.S. consumer is healthy. Bank of America's customers continue to spend freely using their credit cards and other payments for 10% more transaction volume in December and the first half of October than a year earlier. So they're seeing credit cards and other payment methods. So I'm assuming home equity lines. I think it's probably equity lines and credit cards have 10% more transaction volume. And it's because, in my opinion, from what I've seen, people have less money than probably any other time within the last 15 years, with prices being so high. But apparently the CEO of Bank of America is seeing something different. Customers' bank accounts were higher than before the coronavirus pandemic, which struck in early 2020, indicating that they were in a good position to continue spending. Finally, consumer credit remains pristine, with late payment metrics still well below pre-2020 averages, indicating that so far customers have had little difficulty keeping up with their debt. Quote, we're now seeing a gradual move off these lows in early stage delinquencies. Late stage delinquencies are still 40% below the pre-pandemic levels. So I know Bank of America is seeing one thing, but man, I'm talking to people. I talk to real people every single day. And it sounds like Americans now are struggling more than most of them have in their entire life financially. So I'll listen to what the CEO of Bank of America is saying, but I don't know, man. I feel consumer student loan debt is at an all-time high. Consumer credit card debt, from a paper perspective, is not at an all-time high, but from talking to people, it seems like their credit card debt is at an all-time high. Financial stresses are no question at an all-time high, and American consumers have lost more money in this quarter from a monetary perspective, like the amount of US dollars. They've lost more money in this quarter than any other quarter in the last 15 years, since basically 2006 through 2009, that financial crisis. So something is off kilter. And he can say that the US consumer is healthy and he can show his metrics and everything. But from me talking with real people, it sounds like the US consumer is not healthy, and it sounds like the economy is not healthy. That's just my opinion. Now let's take a left turn for a bit. Let's talk the IRS. Now, the IRS released new federal tax brackets and standard deductions for the fiscal year of 2023. Let's take a look at how it's going to impact our tax bill. America's high inflation rate will produce a 7% increase in the size of the standard deduction when workers file their taxes on their 2023 income, according to new inflation adjustments from the Internal Revenue Service. It's also going to pump up tax brackets by 7% as well, according to the annual inflation adjustments the IRS announced Tuesday. Many tax code provisions, but not all, are indexed for inflation, so the announcements are a recurring event. But when inflation is persistently clinging to 4-decade highs, these annual adjustments carry extra significance. When the inflation is it's just repeating that quote. All right. Start with the standard deduction, which is what most people use instead of itemizing deductions. The standard deduction for individuals and married people filing separately will be $13,850 for the 2023 tax year. That is a $900 increase for the upcoming tax year. So it's not going to take place in the 2022 fiscal year filing, but for 2023, which is when we're going to be, filing it for 2024. That's what we are going to be seeing. For married couples filing jointly, the payout climbs to $27,700 for the 2023 tax year. That is a $1,800 increase from this upcoming year, but technically at that point from the previous year. The increases in the marginal tax rates reflect the 7% rise as well. For example, the 2022 tax bracket for this year is over $41,775 for single filers and $83,550 for married couples filing jointly. Next year, the same 2022 tax bracket applies to incomes over $44,725 and over $89,450 for married couples filing jointly. Let's take a gander. So for this upcoming tax year, or this, I guess, current tax year that we are in, but will be filed next year. Let's take a look. Yeah, so this pretty significant one, this 2022, or this 22% one in the 2022 fiscal year, it's going to be $41,775. In 2023 fiscal year, it's going to be $44,725. And then stuff gets bumped up further after that. So this one looks to be about a $6,000 jump. This one looks to be about a $12,000 jump for this tax bracket for 32%. 35% looks like it's jumping about $16,000. And the 37% tax bracket, which is that ultra high income earner, looks to have jumped about almost $40,000. So 7% increase. So yeah, they're saying one of the main reasons is CPI is high. Clearly, it's still hotter than expected, so 8.2% in September. And also last week, that's coming in tandem. These cost of living adjustments for the IRS is also coming in tandem with the Social Security Administration cost of living adjustment of 8.7% to keep up with inflation. So people are down bad. We're also getting an increase to the earned income tax credit. So a taxpayer with at least 3 qualifying children climbs to $7,400 or $7,430, up from $6,935 from the previous year. This is a long-standing credit that is geared at low to moderate income working families who have been hit by red-hot inflation. More than 60 provisions are slated for an increase in line with inflation, but many portions of the tax code are not indexed for inflation. Depending on the circumstances, the taxes or the tax breaks kick in sooner. Capital gains tax rules one example. The IRS lets a taxpayer use capital losses to offset capital gains taxes. If losses exceed gains, the IRS allows a taxpayer to deduct up to $3,000 in excess losses. They can then carry the remainder of the capital losses to future tax years. It's been more than 4 decades since the lawmakers last set the limit. I think they can maybe bump it to 10,000. I feel like that would be good, especially for my crypto bros. I know they are, we specifically, I guess but me included, are down to a point where we can definitely deduct more than $3,000 in capital losses. I'll say that. The rest of this starts to break down just the rest of the earned income tax credit stuff and all the logistics and everything. But yeah, so they're doing a cost of living adjustment for the IRS tax bill. So if your wages aren't really increasing that much compared to inflation, the average wage is still, I think it increased like 5.7% in the average job in the most recent jobs report. Inflation, of course, is at 8.2%. So you're going to have a lower tax rate generally. I think you're going to be taxed on less, if that makes sense. Well, you'll be taxed more because you're increasing your income technically by 5%, but less of it is being taxed at possibly higher rates because the actual inflation of the IRS tax brackets are less than the inflation, or are more than the inflation of the income rates and pay rates and compensation rates. It's fun. This money stuff is fun. These tax brackets are just fun, man. They can get very, very confusing. I think having just a flat tax rate would probably be easier. It would clearly be easier than having tax brackets, but they've designed it this way for a reason. I don't know why the IRS specifically did this. Maybe that's a piece of content that we can explore early in the future. Or in the future at some point. Now, let's take another left turn. It has been 35 years since Black Monday, since October 19th, 1987. The Dow Jones Industrial Average fell 22.6%, making it the largest one-day drop by percentage in the index's history. This was also the first day 35 years ago that Jordan Belfort of A Wolf of Wall Street fame, technically, I guess, going off of the Wolf of Wall Street movie, started trading in the stock market and became a stockbroker. But yeah, 35 years, man. It's very interesting how, these significant market crashes happen, 35, 50, 75, 100 years ago in the case of the Great Depression. And it seems like psychologically the investing mind and the consumer mind, the American consumer and the American investor, things don't really change, It's just, biology is timeless, and these major upswings and downswings and contractions and expansions and recessions and bull markets and bear markets, it's just cyclical. And seeing that, Black Monday happened 35 years ago in 1987, and here we are, 35 years later. We're basically down near the same percent year to date, and consumer sentiment and investor sentiment seems to be extremely low, definitely off from its 2021 or January 1st or 2nd of 2022 highs. But it's important to look back and like when there's significant days like this of a significant anniversary of these market crashes, we can really take a look back and see, what was going on right now, what's going on right now in terms of our market sentiment and what's going on with, the Fed rates and consumer demand. And then we compare it back to Black Monday. It's fun to see parodies. It's fun to see the similarities between the two. And to end off tonight, the student loan forgiveness application launched by our fearless leader, President Joe Robinette Biden, has officially launched, putting relief in sight for 40 million Americans. So those who can take advantage of it, are they going to actually show us the website? Where's the website, man? Hold on. I guess we can actually just take a look at it. I don't have any student loans. I am not in college. Dude, why are they not showing us the student loan forgiveness? Let's just do this. Student loan forgiveness website. Let's see what it looks like. Student aid debt relief application. So for those of you that qualify for student loan forgiveness, so whether it be the $10,000 for non-Pell Grant recipients or $20,000 for federal Pell Grant recipients, get that money, man. Get that money, dude. If they're giving it away, just take it. Just take it. You may be philosophically against the fact that they're forgiving student loans, but you being philosophically against it is not going to stop the fact that they're giving the money out. So you might as well take some. Do I agree with them printing out, $7 trillion during COVID and giving it out to a bunch of people? No, I generally think that was pretty problematic for the economy. Clearly it's problematic for the economy because now we're at, record 40-year high inflation. But hey, if they're giving it out, I'll take the stimulus. I'll take that Golden State stimulus from Gavin Newsom. I'll take that federal tax relief or not federal, the California tax relief that they've been given out to the citizens of California, which I have yet to get yet. And I would like to speak to the manager of California because I would like to get my federal or my state tax relief stimulus. But we will save that for another day. So get you your money, get you your student loans forgiven, y'all, for 40 million Americans. If you're able to take advantage of this, more power to you. I'm happy that you can get rid of, at least $10,000 and at most $20,000 worth of student loans. And if you liked what you saw in the Dylan Holy Experience, feel free, if you're on Twitch, to follow me on Twitch. And if you're coming at me live on YouTube, feel free to subscribe. And then if you're on YouTube, I want you to go over to Twitch and follow me. And then if you're watching on Twitch, I want you to go over to my YouTube and subscribe to me. Then I want both of you parties to go to my Twitter at Real Dylan Holy and follow me. It would be much appreciated. I'm posting. I feel like fun content over there. I'm liking and retweeting some of my friends' stuff too. They know who they are. I feel like it's entertaining content. I like it. I'm also posting all the time just my general thoughts on the markets and consumer sentiment, and I'm staying up to date and posting, what the Dow Jones and the S&P 500 are closing at, sometimes earnings reports. And you will always on Twitter be the first to know when the Dylan Hoy Experience is going live for the midweek, end of the week, or special events. Twitter's the first to know, so feel free to follow at Real Dylan Hoy. Thank you very much for tuning in, members of the millions, on the Dylan Hoy Experience tonight for our midweek market recap. It's always much appreciated. I'm humbled by those watching that they would give me the light of day for their prime time news coverage. I truly love it. And I believe that's all I have to say for tonight. I hope you have a great evening, all of you, and I will see you on Saturday or Sunday. It is to be determined for your end of the week market recap.
Bye.